It begins with a historic announcement. The United States government declares that Chinese companies' stocks will no longer be allowed to trade on U.S. stock exchanges. This decision affects hundreds of publicly listed Chinese firms spanning technology, consumer goods, energy, finance, and industrial sectors. The news spreads immediately across Wall Street, financial institutions, corporate boardrooms, and global investment networks, triggering unprecedented uncertainty and volatility. Analysts scramble to assess which sectors will be most affected, how investors will react, and what ripple effects will emerge across domestic and international markets. The first impact is felt in capital markets. Chinese companies previously listed in the U.S., from tech giants to mid-cap manufacturers, are delisted. American investors holding these stocks face immediate uncertainty, forced liquidation, or conversion into foreign-traded equivalents. Stock prices for U.S.-listed Chinese firms experience dramatic volatility in the hours and days following the announcement, as investors attempt to rebalance portfolios and reduce exposure to now illegal holdings. Market indices containing exposure to these stocks adjust sharply downward. Investor behavior shifts dramatically. Retail investors, mutual funds, and institutional investors all face forced portfolio reallocation. Funds with significant exposure to Chinese equities experience NAV fluctuations, prompting sales of other correlated assets. Hedge funds, ETFs, and pension funds must revise strategy, creating short-term liquidity stress in certain sectors. Stock markets reflect both panic-driven selling and opportunistic repositioning in other domestic and international assets. Financial institutions respond immediately. Brokerages and custodians are tasked with compliance, notifying clients, and managing the logistics of delisting. Trading platforms experience surges in volume as investors offload affected positions. Brokerage fees, transaction volumes, and margin calls surge temporarily, while stocks of firms reliant on cross-border listing revenue face volatility. Corporate strategy adapts rapidly. American companies with supply chains, partnerships, or joint ventures with Chinese firms must reevaluate contracts, pricing, and risk exposure. Industries such as technology, automotive, electronics, and consumer goods experience disruption as Chinese corporate partners adjust to restricted U.S. market access. Stock valuations for U.S. companies heavily tied to Chinese suppliers or clients adjust downward in anticipation of potential revenue loss or operational challenges. Global financial markets react. Investors in Europe, Asia, and Latin America monitor the U.S. decision closely. Chinese domestic exchanges may experience increased trading volume as delisted companies relocate or increase local share issuance. International funds reassess exposure, shifting capital toward alternative markets. U.S. stock markets experience both volatility and sector-specific shifts, reflecting the interconnection of global finance. Technology sectors face pronounced effects. Chinese tech firms involved in semiconductors, artificial intelligence, cloud computing, and consumer electronics lose U.S. capital access. American tech companies reliant on Chinese partnerships or supply chains must adapt quickly. Stock valuations for technology conglomerates, hardware manufacturers, and semiconductor firms adjust based on anticipated disruption or opportunity arising from reduced competition and altered global market dynamics. Consumer markets are affected indirectly. Products dependent on Chinese components, whether electronics, appliances, or automobiles, may experience price volatility, supply delays, or shortages. Retailers adjust inventory and pricing strategies to mitigate impact. Stock prices for U.S. retailers and consumer goods companies reflect both risk and adaptive measures. Bond and fixed income markets experience secondary effects. Funds holding Chinese corporate debt or dollar-denominated bonds face valuation pressure. Credit spreads for high-risk companies widen as investors assess liquidity constraints and potential defaults. Stock valuations for banks, investment funds, and credit insurers reflect heightened risk exposure. Trade dynamics shift. U.S. importers of Chinese goods may face indirect financial pressure as corporate relationships and investment channels are disrupted. Alternative sourcing strategies emerge, potentially increasing costs and affecting corporate margins. Stock markets in import-heavy sectors adjust to reflect anticipated revenue impacts. Investor sentiment swings between fear and opportunity. Some sectors, particularly domestic manufacturing, renewable energy, and technology alternatives, are seen as potential beneficiaries of reduced competition from Chinese firms. Capital reallocation to these sectors produces volatility as markets attempt to price in long-term structural shifts. Corporate mergers, acquisitions, and divestitures accelerate. U.S. companies acquire or invest in assets previously tied to Chinese joint ventures to secure supply chains, technology, or market access. Stock valuations for companies executing strategic M&A reflect anticipated synergies and revenue stabilization, while firms unable to adapt face declines. Employment markets are indirectly affected. Companies relying on Chinese partnerships for products, components, or R&D may reduce workforce requirements or delay hiring. Displaced or underutilized employees in affected sectors face retraining challenges. Stock markets reflect potential declines in consumer spending, as employment risk translates into lower confidence. Financial regulation undergoes scrutiny. Policymakers monitor compliance, foreign exchange flows, and capital movement. Increased enforcement costs and risk mitigation strategies are required by banks and investment firms. Stock prices for financial services reflect operational adjustments and compliance-related expenditures. Global capital flows adjust. Delisted Chinese firms seek alternative funding sources through domestic exchanges or other international markets. American investors explore new avenues for exposure, including ADRs in foreign exchanges or alternative emerging markets. Stock markets respond to the redistribution of capital, creating both winners and losers in the short term. Sectoral investment patterns shift. Technology, renewable energy, and domestic manufacturing attract increased capital as investors seek to reduce geopolitical and regulatory risk. Stock indices tracking these sectors experience relative gains, offsetting declines in international exposure. Corporate governance faces new pressure. U.S. companies must manage international partnerships while navigating political and regulatory risk. Boards adjust risk management frameworks, and investor scrutiny intensifies. Stock valuations reflect governance quality and strategic foresight. Currency markets experience indirect volatility. Capital outflows from delisted Chinese companies, coupled with shifting investment patterns, influence the U.S. dollar and foreign exchange rates. Stock markets reflect sensitivity to currency movements in export-oriented and multinational firms. Consumer behavior adjusts. Products incorporating Chinese technology or components may increase in price or face availability constraints, influencing purchasing decisions. Retail and technology sector revenues are impacted, which is reflected in stock market performance. Financial technology firms experience opportunity. As cross-border investment mechanisms evolve, fintech solutions facilitating compliance, trading, and portfolio management see increased demand. Stock valuations in fintech reflect anticipated growth driven by regulatory adaptation. Corporate debt exposure is reassessed. Banks, credit funds, and institutional lenders evaluate the risk of default or liquidity stress among firms with significant Chinese market exposure. Stock valuations reflect risk mitigation measures and the creditworthiness of affected corporate borrowers. Global trade alliances adapt. China deepens ties with other international partners while the U.S. strengthens domestic production, reshoring, and alternative trade relationships. Stock markets reflect anticipated shifts in global competitiveness, supply chain reliability, and revenue opportunities. Investment in alternative markets and domestic substitutes accelerates. Industries capable of producing domestic alternatives to Chinese products receive heightened capital allocation. Stock valuations for domestic technology, manufacturing, and energy sectors reflect potential revenue gains and long-term strategic advantage. Financial markets experience volatility in anticipation of policy ripple effects. Equity markets price in sector-specific risk, currency fluctuations, and potential geopolitical tension. Bonds and derivatives adjust as institutional investors hedge exposure. Stock prices reflect both short-term uncertainty and long-term adaptation potential. Corporate earnings projections are revised. Companies dependent on Chinese partnerships, supply chains, or market access reduce guidance. Firms poised to benefit from reshoring or domestic substitutes adjust projections upward. Stock markets react accordingly, with sectoral divergence reflecting shifting expectations. Employment and labor markets adjust gradually. Workers in affected industries may be displaced while growth occurs in domestic manufacturing, logistics, and technology sectors. Stock valuations indirectly reflect consumer confidence and spending potential based on employment trends. Consumer spending patterns evolve. Increased domestic production and supply chain shifts influence availability, cost, and consumer choice. Retail and manufacturing sectors adjust pricing and marketing strategies, influencing stock valuations. Technology adoption accelerates. Domestic R&D initiatives benefit from increased investment as reliance on foreign firms diminishes. Companies in artificial intelligence, semiconductors, and renewable energy gain competitive advantage. Stock markets reflect investor confidence in domestic technological leadership. Corporate mergers, acquisitions, and joint ventures proliferate. U.S. companies invest in domestic capacity expansion, strategic alliances, and technology acquisition to offset lost Chinese partnerships. Stock valuations respond to anticipated synergies, long-term revenue stabilization, and market positioning. Global financial institutions reassess exposure. Banks, investment funds, and asset managers restructure portfolios to reduce risk from geopolitical disruption. Stock markets reflect capital reallocation and sector-specific adjustments. Consumer confidence is influenced by market volatility and product availability. Spending patterns may slow, particularly for durable goods reliant on Chinese components, which impacts stock valuations in retail and consumer sectors. Corporate tax and regulatory implications emerge. Increased domestic production to replace lost Chinese supply may benefit from federal incentives. Stock markets reflect potential for enhanced profitability in strategically aligned sectors. Energy, logistics, and transportation sectors experience increased demand. Domestic manufacturing, shipping, and infrastructure expansion create long-term growth opportunities. Stock valuations in these sectors reflect anticipated revenue and investment potential. Financial markets gradually stabilize. Investors adjust to new capital allocation, domestic production initiatives, and regulatory certainty. Sectoral divergence persists, reflecting winners and losers of the policy shift. Corporate strategy focuses on resilience, innovation, and domestic production. Firms capable of quickly adapting supply chains and operational models gain market share. Stock markets reflect both short-term volatility and long-term growth potential. International relations influence trade, technology, and investment flows. China deepens partnerships with other global markets, while the U.S. strengthens domestic and allied economic integration. Stock markets react to geopolitical developments, influencing corporate revenues and global competitiveness. Consumer markets, corporate earnings, and stock indices adjust over time as the economy recalibrates to a domestic-focused and geopolitically safer investment environment. Companies capable of replacing Chinese supply, investing in domestic innovation, and leveraging alternative international partnerships thrive. Stock markets gradually reflect stability, sector-specific opportunity, and long-term structural realignment. The scenario illustrates how banning Chinese stocks from U.S. exchanges would ripple across the economy, influencing corporate strategy, investor behavior, trade, technology, and consumer markets. While volatility and disruption dominate the short term, long-term adaptation favors domestic innovation, strategic partnerships, and resilient supply chains. Stock markets evolve to reflect both risk and opportunity in a transformed economic landscape.